Hi, welcome to the course on money management. We've recently gone over tools for financial planning, and now what we want to go into is managing your liquidity and your credit, meaning managing those short-term assets, whether it be cash inflows, outflows, or short-term liabilities like utilizing credit cards. Let's get started. The art of money management allows you to receive the best returns on your short-term investments while still maintaining the ability to remain liquid enough to cover short-term liabilities. With the proper liquidity, it allows you to avoid unnecessarily spending on credit, which allows you to avoid accumulating high interest rates. There are some disadvantages of maintaining too much liquidity, and we'll talk about that in the next slide. The downside is while your funds are easily convertible to cash, because of the low risk of maintaining a balance in these particular accounts, you're not receiving the most interest rates compared to investing in a bond or a stock. So what you want to do is when you're done developing a financial plan from all of these courses, consolidated, what you want to learn how to do is maintain that proper balance between liquidity and long-term investments. And that's where we're going to get to by the end of all of these courses. Here are a couple examples of short-term investments. I'm going to go over a few of these definitions in later slides, but here are just a couple of examples. If you want to pause and you want to do your own research, get some definitions that goes into a lot more depth than what I'm going to go into in this particular course, you can do so. But I'm going to go over a few examples and a few definitions in the next couple of slides. Money market investments, checking account. Most of you know what a checking account is. Most of you know what a savings deposit is. Most of you know what a certificate of deposit is now. They sell it to you at almost any bank that you're going to once you open an account. You have Treasury bills. The last three are some that people may not be familiar with: asset management accounts, money market funds, and money market deposit accounts. And I'll give you those definitions again in a couple of slides. What is a Treasury bill? A Treasury security is a debt security issued by the U.S. Treasury. T-bills are short-term investments in these Treasury securities where their maturities are less than or equal to a year. Below, I have an example of a T-bill that you purchased for $9,500 with a par value of $10,000, meaning that the original price for a T-bill would be $10,000. And its maturity date is 182 days, or it's going to mature in 6 months from the day that you bought it. Meaning when you bought it at $9,500, 6 months from the time that you bought it, it will be worth $10,000. Now, if you want to calculate how much interest you're earning on that particular investment, what you do is you subtract the initial purchase price from the par value of the T-bill, and you divide that by the purchase price multiplied by the time it takes for the investment to mature. So the par value is $10,000 minus $9,500, which was the purchase price, divided by $9,500, which again was the purchase price, multiplied by 365 divided by 182, you're going to get 10.5% interest, or what you earned from that $9,500 investment was 10.5% interest as it matures within that 6-month period of time. Here are a few other definitions. Asset management account. What it is a consolidation of a brokerage account with a deposit account, and it provides you with one statement. So let's say, for instance, just a wild example, you partner with TD Bank, and TD Bank also has a subsidiary, which is Ameritrade. And you have an account that's a checking account with TD Bank, but it's also a brokerage account, meaning investment account. It's consolidated under one statement. A money market fund are accounts that pool together many different people's money to buy securities with maturities of under a year. And within that account, it allows you a limited number of checks that can be written from that particular account. A money market deposit account requires a minimum balance and pays interest It also gives you a limited number of checks that you're allowed to write out of that particular account without giving you a penalty for writing those checks. Here I'm showing you some advantages and disadvantages of different investment accounts that you can have when you're looking for that liquidity. A checking account, it's very advantageous because it's very liquid. The problem is it doesn't offer any interest. There are some checking accounts that offer interest, but it also requires you to have a high minimum balance. A money market deposit account, again, it's liquid, but it has very low interest rate. A saving account, the same thing, liquid, low interest rate. A treasury bill, the advantage is it has higher interest rates than the first three that we've discussed. However, it has a high purchase price. Again, going back to the example that I showed before, the purchasing of that one particular bill was $9,500. Most people don't have $9,500 laying around. A money market fund, again, it's liquid, but it's not as liquid as the first three we were talking about. And the last one, the advantage is it's very convenient. Everything's under one roof. The only problem is it has a very high minimum balance. This is the end of part 1 of money management. I'm trying to keep them as short as possible so I can keep you guys interested. Come back to look at money management part 2. And after we go over money management, we're going to go into another course, which is managing your credit. It's going to go a little bit over credit scores, credit risk, interest rates, and things of that nature. I appreciate you guys listening. Look forward to seeing you in the next video.